We continue to add customers. Our lending strong. Deposit generation is strong. But what particularly marks this quarter is the fact that our fee income is up on the back of a bigger base of customers and also increasing some of our fees on daily banking and other products. I think costs are on track to meet our expectations. And what we see is that risk costs remains modest through the cycle averages, which means that our customer remains resilient in the current economic situation. And on the back of that strong capital generation and profitability, we have announced a further share buyback of 2.5 billion euros. So we're quite pleased with how things evolved during the first quarter.
Yeah, there's a lot in what you just said, Tanate, but one thing that struck me from the three things you mentioned there about resilience of consumer, improving cost base as well, and improving net fee income is that your jaws are improving as well. That is interesting and very important for this sector because a lot of people have talked about peak earnings, peak net interest margins, peak net interest income as well. Are you saying actually that you can grow your margins in the current environment given those three factors that I highlighted from what you just said?
Well, that depends on the resilience of the current high interest rate environment. I heard on your show talking about the Fed's chairman talking about higher for longer interest rate. That could feed through into what happens with the ECB. But we are comfortable operating resiliently through the current interest rate environment. And even if the rates were to transition to a lower level, I think ING will do fine in whatever rate environment that turns out to be the case over the next few months or years.
Yeah, Tanate, good morning to you. You speak just as well about increasing your fee income, and that's significant because a large part of your business is still interest rate linked. Is there further need to diversify, further need to kind of grow your customer base here as well?
Absolutely. I think we're very focused in terms of turning our revenue generation model to be more what we call capital light, which is focused on fee income. And we have a target over the cycle to grow our fee income annually between 5 to 10%. And one of the big drivers of that fee income growth is growth in what we call primary customers, core customers of ING. And we have been able in the past years to grow those at substantial numbers. And we expect to do so again this year.
Yeah, you speak about an aim to increase that fee income by 5 to 10% then as well. Delinquencies haven't necessarily risen as one might expect in a high interest rate environment then, Tanate. Even the higher cost of living in some respects as well. As you said, resilient consumer. Why do you think that is?
I think our customers have really been able to absorb this 5% or 4% interest rate environment really well. I think what is driving, particularly in the retail side of the business, the resilience is the fact that the labor market remains tight, unemployment is low, and the fact that we operate in a number of Northern European countries where the resilience of the economies are strong in Netherlands, Germany, and Belgium. And so mortgages, which is a big part of our business, remains really solid.
With that in mind then, a lot of people have been talking about the divergence between the Federal Reserve and the ECB. Tanate, nothing you've said today makes me think that the ECB needs to cut more aggressively than its peers around the world. Is that accurate, or actually does Europe need a rate cut?
I would agree with that. I think what goes through the ECB minds is not so dissimilar to the Federal Reserve. It's about the stickiness of inflation, and particularly on wage inflation. I talked a little bit earlier about tight unemployment situation. So we do expect that the discussion around wage inflation will be quite a serious one within the Eurozone, and certainly for us as well, in terms of wage negotiation with the unions across the board.
So, Tanate, if things are steady as she goes and things aren't as bleak as some of the worst commentators or the most bleak commentators are pointing on out there as well, is there something which I've heard a lot from your peers in the industry that is structurally wrong with European banking that can actually be changed so that actually we can lessen the gap between US bank valuations and European bank valuations? Is something at a structural level, whether it's CMU, whether it's banking union, whether it's cross-border transactions, that needs to happen?
Well, I think one of the big proponents from ING is for banking union, right? The free flow of liquidity, free flow of capital among bank subsidiaries of companies like ourselves. at ING with, big subsidiaries in Belgium, in Germany. We would like more freedom to move capital liquidity across our subsidiaries, because at the end of the day, banking is about being digital and about being able to operate at scale. So I think banking union is one of the big solutions to bringing competitiveness to European banking, and we're big proponents and advocate of that.
So who's stopping this, Tanate? Because it's been a long time. As long as I've been sitting in this chair and speaking to eminent C-suite guests like yourself, we've been talking about it. Where's the barrier? Is it Germany?
It's a combination. I think it's reluctance from local regulators from letting go. I think it's also partly, regulatory agenda, it not being the highest agenda for quite some time. But I do see more momentum, particularly in capital markets union, getting traction from the ECB and other regulators.